In this video, we are going to continue talking about consolidated financial statements after acquisition by going through an example using the equity method at the first year end. In order to prepare our eliminating entries for our first year end, we're going to have to modify the eliminating entries that we've already learned slightly. So remember that our starting point is taking our parent general ledger and adding to it our subsidiary general ledger, and the eliminating entries serve to make modifications to that sum that will make them better representations of the consolidated entity. So we first are going to start by eliminating any intercompany transactions, which we have talked about to some extent, and this is going to include current year dividends. We're then going to eliminate investment income, but this is going to apply only to the equity method because only under the equity method would the parent have recorded any investment income in the first place. Then, for number 3, we're going to establish reciprocity. This is a special entry that applies only to the cost method and only starting in year 2. So for right now, we're going to put that on the back burner because our example is going to be for the equity method. And of course, we're starting in year 1, but keep that in the back of your mind. We will come back to it. Then number 4 and 5 are our eliminating entries that we practiced considerably last chapter, but with a little bit of a modification. So when we eliminate our subsidiary equity, our entry where we eliminate the retained earnings of our subsidiary, we are now going to make sure that we note that that is the beginning balance of retained earnings as of the beginning of the period that we are consolidating. The reason for this is that we're going to have to prepare a retained earnings statement, which is essentially a roll forward, where it starts with a beginning balance, adds net income, subtracts dividends, and calculates our ending balance of retained earnings. And so because we're going to have to be able to put that statement together, we need to be able to identify the beginning balance of retained earnings. Then we let the statement do its thing to calculate the ending balance and populate that into our balance sheet. Then for number 5, we're going to allocate our difference between implied and book. For now, this is exactly the same as it was on the date of acquisition. As I've mentioned before, we're going to just keep adding complication after complication as we move through the course. And so we will have steps that come after number 5, but for now, number 5 will be the same as we've been doing it, and we'll leave it there. So let's take a look at an example where we're going to practice using these 5 steps. In this example, we are going to be looking at a company where on January 1st of 2014, PERT Company purchased 85% of the outstanding common stock of Sales Company for $350,000. On that date, Sales Company's stockholder equity consisted of common stock of $100,000, other contributed capital of $40,000, and retained earnings of $140,000. PERT Company paid more than the book value of net assets acquired because the recorded cost of Sales Company's land was significantly higher than its fair value, or significantly less than its fair value. During 2014, Sales Company earned $148,000 and declared and paid a $50,000 dividend. PERT Company used the equity method to record its investment in Sales Company. So the first thing it asks us to do is to prepare the investment-related entries on PERT Company's books for 2014. But I'm actually going to take a step back and we're going to complete the computation and allocation of differences schedule first because 1, you should do it for every problem, and I'm trying to reinforce that. And 2, it's the thing we would do on the date of acquisition, so I'm going to follow this chronologically. So on the date of acquisition, we would complete this. Then throughout the year, we would do those investment-related entries that they're asking us to do up until we get to that first year end and need to do our consolidation. So the computation and allocation of differences schedule is going to start with us entering our ownership percentage, which is 85%. We know that the total column is always 100. So that means that that leaves us with 15% for our non-controlling interest. Our parent share cost us $350,000 to get that 85% interest. We're going to assume that we could have bought the remaining 15% at the same rate per share. And so we're going to estimate the total value of the entity as a whole by taking our purchase price, the $350,000, and dividing by our ownership percentage. So that gives us a total value of $411,765. We're going to multiply that by 15%. And that gives us the value of the non-controlling shares at $61,765. We're then going to take this price implied by our purchase price, or the implied value, And we're going to compare that to the book value of the entity as a whole. And so to do that, we are going to calculate the book value by adding up all of the equity accounts. This subsidiary had 3 equity accounts on the date of acquisition: common stock, other contributed capital, and retained earnings. So we're going to list them all. Common stock on the date of acquisition was $100,000. Other contributed capital was $40,000. And retained earnings was $140,000. We're going to add those up, and we get a total book value of $280,000. We're next going to compare our implied value to that book value to calculate our difference between implied and book. And so our difference between implied and book is $131,765. So that means we were basically willing to pay that much more than book value for this entity. And so that could be due to 2 reasons. It could be because we believe that the fair value of the net assets is greater than the book value. And so we would be willing to pay that. Or it could be that future earnings potential that we are calling goodwill. So, we have to go back to our problem here to get more information. And it tells us that they paid more than the book value of net assets because land was worth more. And so what they're telling us there is to allocate this entire amount to land as a fair value adjustment, which means there is nothing left over to be goodwill or a gain on bargain purchase. So now we can get to the part that they actually wanted us to do. And that was prepare the investment related entries on PERT's books. So the first one is to record that actual investment. So the reason that we had to do this CAD in the first place. And so this is straight from your investments chapter. We are going to debit investment in S, and we're going to credit cash. So we paid cash and we received our investment. How much cash did we pay? Well, we paid $350,000. And so that is what our investment is worth on day 1. Now notice that our entries we're doing here are shaded yellow because they've asked us to actually do the entries on the parent general ledger. So right now we're not doing anything related to consolidations. This entire section right here that we're doing, you already know from our investments chapter. The next one is to record the parent portion of the subsidiary income. And so that's just saying under the equity method, which is what we're doing here, we remember that when our subsidiary records income, we as the parent also record investment income, and we increase our investment in S as long as they had a positive income. So if we come up here, we see that they did earn $148,000. That's positive net income. So that's going to increase the value of our investment. So we're going to debit investment in S. And we're going to do so for our share of that difference. So, or of that net income. So that's $148,000 times 85%. So again, this is just the equity method of accounting for an investment or an equity investment. And so then our credit account here is going to be investment income, or remember this book says, uses a little bit different titles. So this is going to be equity in S income, but this is just investment income. Then the other time we do an entry for the equity method is when our subsidiary pays out dividends. So our subsidiary did pay out dividends. So that's going to be cash that is received. We're going to go out to the mailbox and we're going to see a check in the mail. We're going to cash it. And then the question is, where do we record the offset? So under the equity method, we treat this as a return of our investment. And so that's going to decrease investment in S. So they paid out dividends of $50,000. And 85% of those would have come to us as the majority shareholder. Okay, so again, this section here, nothing new. We already knew how to do all of this from our investments chapter. Now, the part that's going to change a little bit is that we now need to do our eliminating entries. And so our eliminating entries are those same 5 that were listed on our slide that we just talked about. And we are going to start by doing any intercompany transactions, which includes current year dividends. So if you think about our dividends, when we recorded them up here, we debited cash and credited investment in S. Now the problem is that you can't pay dividends to yourself. But when we add up the cash should be part of the consolidated entity. So it doesn't matter if we're adding it up on the parent's general ledger or if we're adding it in from the subsidiary's general ledger. So let's take a minute to think about what the subsidiary would have done. So when the subsidiary paid their dividends, what they would have done is they're giving up cash and they are giving up that whole amount of cash, which is, let me check again, $50,000. And they are declaring dividends. So they're going to say dividends declared. So this is an intercompany transaction because we don't care about the cash. The cash is going to be, again, like I said, we don't care if we add it up from our parent general ledger or our subsidiary, but we don't want to recognize dividends paid to ourselves because you can't pay dividends to yourself. So that means that we're going to cancel out the other half of these two transactions. And so when we have an intercompany transaction, our eliminating entry is going to have our debits from either our parent or our sub and our credits from the other one. So the entry is going across the two entities to cancel out this transaction. So here we want to get rid of this credit to investment in S. So we're going to debit investment in S. And over here, we want to get rid of dividends declared. That was a debit, so we're going to credit it. And I'm just going to note that that's subsidiary, just to help us keep track of what's going on. Now, these amounts don't match, but that's okay. We want to get rid of all of the investment in S amount, that $42,000, because those are all intercompany dividends. Those are all dividends that were received from our subsidiary. But over here, not all of these are intercompany because some of those are going to the non-controlling shareholders. So some of those are fine. The excess above and beyond the $42,500 are totally fine. Those should be recorded as dividends. So we're going to leave that alone, and we're just going to eliminate the intercompany portion. Okay. Then our next entry is to eliminate investment income. And again, that's under the equity method only, but we're doing the equity method. So that's something we need to do. And so again, we're going to refer back up here to the entries that we already did. And so during the year, we recorded investment income of $125,800. And so we don't want to record any of that investment income because instead we're going to take our subsidiary's entire income statement and add it to our parent income statement. So we're going to undo this as if it never happened, and we're just going to reverse it in its entirety. So we originally credited equity in S income, so we're going to debit it. And we originally debited investment in S, so we're going to credit it. And we want to undo that whole amount. So we are literally just undoing that entry. Now remember, these are now orange entries. So these are happening on our work paper outside the general ledger. So this entry up here still stays on the parent general ledger. We still have record of the fact that we recorded income from our subsidiary. But for financial reporting purposes, we're getting rid of it on our worksheet before we prepare our financial statements, before we report to the outside world. All right, entry number 3 is only for the cost method, and we are doing the equity method, so we're going to ignore that. And so now we are down to the one we already know how to do, which is where we are going to eliminate our subsidiary equity. So we come up here and our computation and allocation of differences schedule still helps us out. We know we have 3 equity accounts that are all going to need to be eliminated. Remembering that our starting point is that we've already taken our parent general ledger and added to it our subsidiary general ledger, and now we need to get rid of some things. Our equity accounts are a normal credit balance. So to get rid of them, we're going to debit them. So we're going to debit common stock of the subsidiary, other contributed capital of our subsidiary. And the thing that is new here is we want to specify the beginning balance of retained earnings. And so here they're nice to us. It's a January 1st start. So we're just going to say 1/1 or January 1st retained earnings of our subsidiary. And so again, we're using January 1st because our roll forward schedule is going to do the job of rolling forward retained earnings on our financial statements on our worksheet. Okay, so I'm going to go through and do all of the account names, then we'll come back and talk about amounts. So next, we know we need to get rid of investment in S. Investment in S is normally a debit balance, so we are going to credit it. So we've got rid of our subsidiary equity. We got rid of investment in S. And now we need to establish our non-controlling interest. That's a new equity account. So we're going to credit non-controlling interest. And then finally, we're going to take a peek at our computation and allocation of differences schedule again. And we see that our difference between implied and book is positive, which means that's going to be a debit in this first entry. All right. So as time moves on, the amounts here are going to change from what they were recorded in our computation and allocation of differences schedule as. Now, a few places where we get a little bit lucky. Our book is nice to us, and we never reach the particular complication of our parent company, or sorry, our subsidiary company issuing more stock or changing the amount of stock that's outstanding, because that would change the ownership percentages and it makes a whole big ugly thing. So for the purposes of our class, common stock will always be the same as it was on the date of acquisition, and the amount that it was on the date of acquisition can always be found on our computation and allocation of differences schedule. So common stock will be the same, as will other contributed capital. And again, that's just because our book is nice to us. We don't reach that particular complication. Now, the other one that will always be the same is difference between implied and book. So the difference between implied and book stays the same because it is calculated on the date of acquisition using historical information about the subsidiary and information about the fair values of those items on the date of acquisition. And so because of that, our difference between implied and book is always going to be whatever it was on the date of acquisition, or at least once the measurement period is closed and this CID is locked down. Okay, so then the one that's problematic is this 1/1 retained earnings. So retained earnings is necessarily going to change over time. Unless our subsidiary breaks even exactly every year and never pays out any dividends, retained earnings is going to change. And so in our first year, we have to think about, okay, well, what was retained earnings at the beginning of the year? Well, we get a little bit lucky here because our acquisition date was 1/1 of the current year. And so our acquisition date is memorialized in our computation and allocation of differences schedule. So far, absolutely everything has been the same as it was on the date of acquisition. Now, if all of our debits are the same as they were on acquisition, then all of our credits have to be too. Otherwise, this thing isn't going to balance. So we can again go back to our computation and allocation of differences schedule, and that's going to get us $350,000 for our investment in S. And $61,765 for non-controlling interest. Then the only thing left to do will be to allocate our difference between implied and book, which we initially debited, so we are going to credit. And then we need to reallocate it. And remember, we are first going to allocate to any fair value adjustments, and then anything left over is goodwill. But they told us that the entire thing is due to one fair value adjustment to land. So we are going to allocate the entire thing to land.
and then we are done.